It blows my mind that 77% of people can't pass a basic tax 101 test. I mean, it's crazy, but it's not the least bit surprising, and I don't think it's their fault when you consider that the tax code is over 6,500 pages. I mean, imagine trying to read a 6,500 page encyclopedia just to understand your paycheck. No wonder why taxes confuse nearly every single person. In fact, a recent study shows that only 2% of people actually have proficient tax knowledge. So in this video, our goal is to simplify these concepts for you and help you understand how taxes work and how you can minimize how much you're giving to Uncle Sam. And do me a favor, make sure you stay till the end where I share 5 simple ways that you can pay less in taxes. If we haven't met yet, I'm Johnathan Rankin, the owner of Theorem Wealth Management. We're a retirement planning firm that's been helping people across the country plan and execute their retirement goals for going on 20 years now. Let's start by talking about income taxes. You see, the US uses what's called a progressive tax system. That means that the more money you earn, then the higher your tax rate becomes. However, not every single dollar gets taxed at that top rate because of what's called the marginal tax rate. So think of it as filling a series of different sized water buckets. Each bucket represents a tax bracket. So you might fill up the first one pretty quickly because it's relatively small, but as you earn more, then you start filling up larger buckets. For example, if you're a married couple with a taxable income of $250,000, then it might seem like all that income should be taxed at 24% because that's the highest rate for you. But in reality, only the income that flows into that bracket gets taxed at 24%. The rest of your income is taxed at lower rates. You know, remember the days of cell phone plans that came with minute limits? Well, think of your income like a cell phone plan. The plan offers a set number of minutes or data for a flat fee, but once you exceed that limit, then extra minutes or gigabytes cost more. Just as the only extra usage beyond your plan's allowance is charged at the higher rate, only your income that exceeds thresholds is taxed at the higher rate. Your overall effective tax rate is the total tax you pay divided by your income. So it might be closer to, let's say, 15.4% instead of a flat 24%. And a lot of people get really anxious and confused when they try to figure out the difference between the tax bracket they're in and their marginal tax rate. And this mix-up is especially common as you move into higher tax brackets. You see, after all, as your income grows, it usually comes from a variety of sources rather than just your regular paycheck. Whether it's bonuses, stock, deferred compensation, it's no longer just a salary. For example, bonuses and restricted stock units, or RSUs, are another area of confusion that is pretty common. You see, people mistakenly assume that these forms of income are taxed at an extra high rate, when in reality, they're taxed just like your regular earnings. What many don't realize is that the confusion comes from the difference between tax withholding and what your actual tax rate is. Think about it like you're shopping online and you have a promo code to enter. But as you add things to your cart, it still stresses you out because it's showing you the gross total and not what the price is going to be after you enter the promo code. That's pretty similar to how employers handle bonuses. They might withhold money at flat rates like 22% or use other methods that temporarily suggest that you're in a higher tax bracket. But at the end of the year, those bonuses simply merge with your overall income and are taxed accordingly. Think of it as temporarily high price tag that eventually gets readjusted. The difference between what's withheld from your paycheck and your actual liability is another subtle yet important nuance. See, many assume that what's taken out of their paycheck exactly matches what they owe. However, the amount withheld is essentially an educated guess based on the details that you provide on the Form W-4. Now, it can either be spot on, could be a bit too much, or maybe even too little. It's like setting the thermostat based on the weather forecast. You know, sometimes you overestimate how cold it's going to be, sometimes you underestimate it. It's the same thing with tax withholding. It's designed to approximate what your eventual tax bill is going to be, but you've got to review it, and it's essential to make sure that you're making adjustments along the way to avoid facing any massive surprises when you file your taxes. Nobody likes to expect they're getting a refund only to have a large bill come into play. So make sure you're checking in on that at least once a year. Now, let's shift gears to talk about capital gains, which are essentially taxes that you pay on the profits made from selling assets like stocks, bonds, or even a house if it isn't exempt. You see, the first step in understanding capital gains is figuring out what your cost basis is. This is the amount that you originally paid for the asset. Think of it like buying a vintage car at an auction. The price you paid becomes the cost basis, and any profit that you make when you sell the car later, that's your capital gain. Now here's where it gets even more interesting. You see, the tax rate applied to your capital gain depends on the length of time that you held onto the asset. So if you sell the asset before owning it for a full year, then that profit is labeled short-term capital gains and is actually taxed to your regular income rate. And that can climb as high as 37% for some taxpayers, and there's additional state taxes in some states. However, if you hold the asset for more than a year, then you benefit from more favorable long-term capital gains rates, which are typically 0%, 15%, or 20%, and this lower rate can significantly reduce your tax liability. There's been a lot of research and data that has been poured into this, and IRS data shows that by consistently adopting a strategic approach, by holding on to investments for more than a year, you could save a significant amount of money in taxes, even when accounting for additional factors like state income taxes or potential extra costs like the 3.8% net investment tax. The advantages of long-term cap gains treatment are clear, and by understanding these nuances, you can make more informed decisions about your investments and optimize your tax strategy. Speaking of investment accounts, the tax treatment across different types dramatically impacts your net returns over time. For example, retirement accounts offer some of the most advantageous tax conditions. Like a Roth account, you invest after-tax dollars and they grow tax-free, and when you take money out, it's tax-free. On the other hand, traditional retirement accounts like a traditional 401k or IRA, those let you contribute pre-tax dollars, allowing you to postpone taxes until you withdraw funds in retirement when your income might be lower. Now, there are taxable brokerage accounts where dividends, interest, and realized capital gains are taxed annually, similar to paying an entry fee at a recurring event. And then there are taxable brokerage accounts where dividends, interest, and realized capital gains are taxed every single year. I can't stress how important it is to understand the different types of accounts and their taxation when building your retirement plan. I've seen so many people enter retirement with just one type of account, usually a pre-tax 401k, and they want to know what can they do about taxes in retirement. The reality is where you can save taxes in retirement is by planning years and years ahead. And so it's important to understand what type of accounts you have, how they're going to be taxed, and what that means for your long-term retirement. See, the US tax system can feel like this giant puzzle with thousands of pieces, but when you break it down into manageable parts, it becomes a lot easier to understand and navigate. By getting a handle on marginal tax rates, monitoring your tax withholding, and leveraging long-term capital gains, you can really transform your financial strategy and keep a lot more of your money. Now, before we get out of here are the 5 strategies that I promised I would share to help you reduce your taxes. The first is to max out your tax advantaged accounts. Increase your contributions to accounts like your 401k, traditional IRA, or health savings account. To me, the health savings account is one of the most underutilized accounts for retirement that many people are not taking advantage of. Not only do these accounts lower your taxable income today, but they'll also set you up for future savings, whether it's for retirement or for healthcare. Plus, some of these accounts offer tax-free growth opportunities. The next thing you're going to want to do is capitalize on your deductions. You see, deductions like mortgage interest, state and local taxes up to the allowable limit, and charitable donations can significantly decrease your taxable income. So keeping a record of expenses throughout the year ensures that you don't miss out on any of the deductions when tax season rolls around. Now, the third thing that you could do is take advantage of tax credits. See, unlike deductions that reduce your taxable income, tax credits directly cut down the amount of tax that you owe. So whether you qualify for education credits, energy efficient home improvement credits, or child and dependent care credits, they can substantially reduce your overall tax bill. And the fourth thing you could do is you can employ tax loss harvesting. So if some of your investments in your portfolio are underperforming, consider selling them to offset gains from other investments. This strategy can help reduce the taxes you owe on your investment income, effectively lowering your overall tax bill. Now, the fifth thing you could do is you can explore income deferral strategies. There are times when postponing income, like delaying a bonus or shifting the timing of your business revenue, can place you in a lower tax bracket next year. So by deferring income, you may be able to reduce your current tax burden and pay less tax in the future. You see, for going on 20 years now, I've been helping people plan ways to achieve their financial goals. And over the course of my career, I've not met one person that's ever wanted to pay more in taxes. Not one. Now, while understanding our tax system and strategies to help reduce taxes, that's important, but the number one thing that you can do to reduce taxes is to put together a financial plan. You see, most people want to start by implementing strategies first, and then figure out how they fit into their long-term financial plan. This is like trying to get into shape and the first thing you do is jump into a cold plunge or a sauna just because you saw it on social media. Instead, you've got to figure out what your diet's going to look like, your workout routine. You got to start with a plan first. So start by putting together a detailed financial plan to see which strategy fits best for you. And this is where you can uncover some of the most effective ways to reduce taxes. And if you have no clue where to start, or you just want help seeing where you can reduce taxes, then use the link in the description below. Our team, we'd be happy to put together a detailed analysis showing how you can achieve your financial goals while reducing your taxes. We do look forward to hearing from you, and if you found this video helpful, do me a favor, support our channel and what we do by hitting that subscribe button. Thank you for watching it, and make sure you check out this video coming up next. I will see you there.